While everyone is busy arguing over Bitcoin ETFs, the giant piggy bank holding your retirement is quietly leaking cash faster than a crypto bro at a VIP table. Your 401k was sold as a promise, but I'm going to show you why it's actually just a $30 trillion game of musical chairs where the music has already stopped. On the surface, everything seems to be going great. The stock market is at an all-time high. The Federal Reserve's inflation strategy seems to be working, and Arby's just released steak nuggets. But underneath, there's trouble brewing, because while everyone is busy debating the next interest rate cut or whether Tucker Carlson wears a toupee, there's a crisis bubbling in the pension world that nobody seems to be talking about. See, the United States is currently drowning in debt, with a national debt that has officially crossed $38 trillion. Borrowing isn't free, and we now spend $1 trillion a year just to service the interest on that debt, which is more than we spend on national defense or veterans benefits. This spending problem is exactly how we ended up running a nearly $2 trillion annual deficit, acting like a college freshman with a credit card and no concept of consequences. But that's not even the real issue. The real issue is that the giant institutional investors, the pension funds and endowments that manage your future, are chasing alpha harder than Wall Street interns chase validation from a managing director who doesn't even know their name. To understand why your retirement is in the crosshairs, we have to rewind to the early 90s. After Japan's asset bubble burst in 1992, their economy hit pause, and the Bank of Japan cut interest rates to zero or even below zero. This created a multi-decade-long global shopping spree where Japanese pension funds and banks became the world's ATM. They would borrow money in yen at near zero and invest it in foreign assets that yielded more, a process known as the yen carry trade. This trade became the Japanese Wi-Fi that powered global markets for years. But in 2024, that assumption broke. Japan finally raised interest rates, and the free money trade isn't so free anymore. As the math flips, capital starts to return home, a process called repatriation, which is one of the biggest threats to global markets today. While you're hyper-analyzing Jerome Powell's press conferences like it's a new GTA 6 trailer, the long end of the yield curve is being driven by supply and demand. If Japan, one of the largest buyers of U.S. debt, stops buying, yields have to rise to attract new buyers, which makes everything from your mortgage to corporate credit more expensive. This is where the ugly part of the story begins. Because traditional bonds were yielding next to nothing for a decade, pension funds got desperate. They started looking for stable returns without the stock-like mood swings, and they found it in an industry so dull-sounding it makes municipal bonds look sexy. Private credit. Private credit is now a $2.5 trillion juggernaut where non-bank lenders like Blackstone or Apollo cut direct loans to companies. It's basically the sketchy uncle of finance who says, "Don't worry about the report card. I'll give you cash right now, but you might not like the interest rate." Pension funds love this because it offers equity-like returns with bond-like volatility, making it a Goldilocks asset for anyone managing $30 trillion. But there's a catch. There's no centralized exchange, no liquidity, and no public price quotes. Nobody really knows how much these loans are worth until someone stops paying, and even then, it's a guessing game. Investors are happily ignoring the growing cracks as long as they get their 8 to 10% a year, pretending the music will never stop. And while your pension is gambling in the shadows, the government's untouchable giants, Social Security and Medicare, are also hitting a wall. The Social Security Trust Fund is projected to be insolvent by 2034, which means benefits will be automatically cut by 20%, whether Congress likes it or not. Medicare is in a similar spot, with its hospital insurance fund estimated to be insolvent by 2033. We're overpaying for programs like Medicare Advantage by up to $127 billion annually, but fixing it would infuriate the health insurance industry, so the waste continues. So, if you look at the American economy from a debt-first perspective, it doesn't look like the booming economy you see on CNBC. It looks more like a giant game of hot potato where everyone is hoping the music doesn't stop. We've been trained to set and forget our 401ks, but that passive investing strategy has turned us into guaranteed buyers for whatever garbage gets added to the index, including unprofitable companies listing at peak valuations. The math of the situation is simple. We are financing the present by hollowing out the future. The crisis isn't loud or sudden. It's quiet, gradual, and happening in plain sight. It's a digital mirage that disappears the second you reach for it. I made this channel because I want to shine a light on the issues that traditional financial media won't touch because they don't get clicks. If you're interested in knowing what's actually happening in the markets, hit subscribe and turn notifications on. I want to hear your thoughts. Do you think 2026 is the year things start to break, or can we keep the game going a bit longer? Drop your take in the comments, because sometimes the best data comes from the people living in the economy, not the ones measuring it.